Welcome to another episode of A Quest for Twice. Today is December 6th. Today I'm going to do the first part of my year-end review. So let's look at the forest before the trees. So what happened in 2022? So these three charts really described what happened very well. The first one on the left is the trimmed PCE price index year over year. So we can see that the PCE started to take off in the summer of 2021, then started to go up relentlessly from about 3% at the beginning of 2022 to over 4.5% currently in November. Basically, the inflation has been very persistent. And in turn, the Federal Reserve started to aggressively raise interest rates in the effort to tame the inflation beast. So we can see in the middle chart, the Fed tightening cycles in this year drawn in red versus previous cycles. We can see that so far the Fed has raised interest rate by 3.75 percentage points, and that's done in 9 months. The speed of increase and the magnitude of increase are both very impressive and very aggressive. So what does this tightening cycle do to the economy? It's best described in the chart on the right. That shows the earning estimate in the past. The top line is estimated for the earning 2023. The one below it is earning for 2022. Then it's 2021. So we can see coming out of the pandemic recession, the earning in 2021 was raised dramatically from $160 to over $200. What's interesting about the earning for the year of 2022? It was on an upward trajectory until the summer of this year. Then the earning was revised down gradually. However, the downward revision was not as severe as the downward revision for the earning in 2023. The significant downward revision for 2023 is a direct consequence of the very aggressive Fed tightening cycle. So as of December, next year's earning is estimated a little below $230. So what happened to stocks? The S&P 500 declined 16% year to date. That's primarily driven by PE decline. As we can see, the 2022 earning estimate, although was revised down slightly, it held up pretty well. However, if we look at the chart on the bottom left, we can see the PE at the beginning of this year was over 22. Now it's less than 19. This PE downward shift is a response to the anticipated earning reduction in next year. However, if we look under the hood, we can actually see that it's also a risk-off response to the rising interest rate. The evidence is in that looking at the middle table, we can see on the growth sector, the stocks significantly underperformed with 30% or more decline in 1 year. For the value stocks, the large and medium value stocks declined less than 10% in the last 1 year. The final evidence is to compare ARK Innovation ETF to NASDAQ. So in the last 12 months, NASDAQ declined more than 26%, while ARK declined more than 62%. ARK ETF invests in the small and high potential companies may prosper in the future, but currently most of them are very expensive, measured in PE, or they are even losing money. So in the last 12 months, investors have been moving out of the profitless, high-risk, small growth companies. How did my investment do in this difficult risk-off year? So year to date, my portfolio has been down 5% versus a 16% decline for S&P 500. However, the returns of the individual stocks in my portfolio had a very large dispersion. In aggregate, my growth portfolio currently is about 20% of my total portfolio is down by 40%. By the way, 1 year ago, my growth portfolio was also about 20% of my total portfolio. However, I added a fresh new investment to my growth portfolio in 2022. That's why its current weight is still 20%. Now let's look at the histogram of my portfolio performance. So I have one company stock, Energy Transfer, returned more than 43% in this year. However, I also had one company stock, Upstart, declined by more than 77%. Then the rest of my portfolio kind of clustered in the middle. You can see that I have one stock return is greater than negative 17%, which is about the S&P 500 return year to date. And 4 stocks returned between up 7% to down 5%. And 2 companies up for more than 7%. The rest of my stocks underperformed compared to S&P 500. Most of them are in my growth portfolio, but there are 2 exceptions, which I will cover later in this review. Now, let me review my stock performances against the predictions made about 1 year ago. In this table, the left shows the tickers of the stocks in my portfolio. Then the next one is the weight of that stock in my portfolio about 1 year ago. Then I provided 2 scenarios. One was a risk on, the other one was a risk off, and the predictions of the stock performance against the S&P 500 under those 2 scenarios. I also noted my conviction in my prediction. The last column is the price as of end of yesterday, December 5th. So since we had a risk of a year, so I only look at the predictions under that scenario. For Aqua, I had a high conviction it would outperform the market. Turns out I was right. And the same goes for Energy Transfer, high conviction of outperformance. Note that those 2 adding together is about 56 of my total portfolio. I also had a high conviction of outperformance for Kinder Morgan, Ingredion, and Emerson. All those were right. I had a medium conviction of outperformance for Walker Dunlop. Turns out I was wrong. It significantly underperformed the market. So I'm going to get into that later in this review. For Mercado Libre, Emote, Amazon JFrog, and Boston Beer, I had either medium conviction or low conviction. And for the growth companies, most of them, I believed they would underperform in a risk-off scenario. Turns out I was right. The only wrong prediction was Boston Beer. I had a low conviction of outperformance. But to me, the low conviction ones were not that important. So the real off-mark prediction was Walker Dunlop. So in terms of my performance summary, my portfolio exited 2021 with 4.3 times of my unit of measurement. I added 1.5 unit fresh capital in this year and came out of this year with 5.4x on December 6th. As I mentioned earlier, my investment return was about down 5% versus down 16% by S&P 500. For this reason, my performance grade for capital efficiency is A minus because my target is to beat S&P 500 by at least 10 percentage points. For risk management, I also give myself A minus. That's because this outperformance is significant in a risk-off year after my portfolio returned 66% last year. Outperforming the market in a risk-off scenario to me means a good risk management. However, I do want to note that the energy transfer and aqua are a huge part of my portfolio. My portfolio outperformance was driven by the outperformance of the only two stocks. So that's why I give myself an A minus instead of A or A plus. In a down market year, I give myself a B for materiality in terms of investment return. So what are my lessons learned? First, let me review my lessons learned from previous 2 years. From 2020, I said any selling needs to have strong conviction and purpose. So I made exchanges in 2022, but no outright sell to bet against the market. Despite I thought the risk off was a very possible scenario. Number two, do not nickel and dime the market. So in this year, I sold the put options in order to buy stocks at a lower price. So this may go against my lessons learned number two from 2020. However, this year is a down market year, so I think some prudent and go slow approach for entering into the market is warranted. Number three, market can be irrational. So this is also a lesson I'm relearning in this year. I'm going to get into that later in this review. From last year, I learned that cheapness is not a good reason to buy a growth company. So it turns out that I bought some growth companies too early in this year because they had a significant decline. So I don't think I learned my lesson very well. So that's something to think about in the year of 2023. Another lesson I learned from last year was don't buy a company I cannot understand. However, I do want to point out that by definition, there are high uncertainties in growth companies. So if I wait until the uncertainties all dissipate, then I will miss opportunities. So if I want to capture opportunities investing in growth companies, then I have to tolerate some uncertainties. Number three, don't be sloppy during investing. So this year, I did several deep dives into several potential targets to add to my portfolio. However, I also had a 3% position in Fidelity Information Services without the deep dive. The decision was based on recommendations by Morningstar and Hillary Kramer. However, so far, FIS had a 20% loss compared to my entry point. So I think I was sloppy also when I built my position in FIS. I have to be more disciplined in investing in companies next year. So what lessons did I learn from 2022? The first one is I predicted Walker and Dunlop would outperform S&P 500 in a risk-off year. Turns out it declined by more than 42% so far versus 16% for S&P 500. So let me explain the reasons of the underperformance. As I mentioned earlier, the Fed rapidly raised the interest rate, which caused buyers to stay on the sideline. And Walker Dunlop derives revenue from transaction volumes. For each transaction, Walker Dunlop will take a cut as a sales commission. So I did not appreciate these linkages. In other words, I did not imagine the economic scenario that caused the risk off, which is rapidly rising interest rates. Then I did not really think through Walker Dunlop's business will be affected by the rising interest rates. Another stock in my portfolio, Upstart, had similar struggles. So the lesson I learned was the need to incorporate the macroeconomic scenarios in my portfolio planning instead of just only look at the scenarios in changes of PE ratios. The second lesson I learned was the market can be irrational. And here is a good example. So if we look at the JFrog's quarterly revenue and gross profit, that's plotted at the bottom right. Note that there is very little seasonality to JFrog's business performance. That's why it's a very good example. We can see that its underlying business is very strong despite the rising interest rates. The quarterly revenue almost stays on the trend line perfectly. So with such a consistent business performance, what should an investor expect in the JFrog's stock price? I would say it should be relatively stable because the business performance is stable. But if we look at the actual JFrog's stock price that's plotted on the top right, we can see that it actually had a significant price decline, 32% in this year, and 67% since IPO in the fall of 2020. Because of the steady revenue growth and the significant price decline, the valuation of the JFrog has changed significantly. At the end of 2020, price over sales was 41 and 14 at the end of 2021, and now it's only 8. To me, this is a very strong evidence of risk of sentiment impact on the stock price, and JFrog is a victim of this sentiment. And to me, that is irrational in terms of evaluating the net worth of the company. And my conclusion is the market is not rationally evaluating the growth companies at this point. And that presents investment opportunities to me. In the next episode, which will be the final one for this year, I will make predictions for next year and develop my investment strategy accordingly. Until next time, happy investing.